Hello friends, greetings of the day, and today welcome to the online session of business economics once again. Now in this particular session, as you know that we are learning chapter number 3, that is theory of production cost, and in this theory of production cost uh, we have started unit number 2, that is theory of cost. Now in this theory of cost, we have already completed the meaning of cost analysis, and then we had completed the meaning of implicit cost, explicit cost, and on the basis of this implicit cost and explicit cost, we had learnt two different types, that was accounting cost and economic cost. Now in this session, we are going to learn another concepts of cost. One is outlay cost and another is opportunity cost. Now outlay cost means all those actual expenditures of fund, that is on wages, on rent, on interest, etc. That means whatever we have actually paid to the outside factors of production, that will be considered as outlay cost. Now again, remember about that explicit cost was also saying the same thing. Wages, rent, interest paid to the outside factors, that is considered as explicit cost, that was also considered as an accounting cost. So the conclusion is accounting cost is also known as explicit cost, and it is also known as outlay cost. So all of them are another names, the thing are the same. It can be considered as outlay cost, it can be considered as explicit cost, or it can be considered as the accounting cost. So all the amount paid, actually paid by the business to the outside suppliers or factors of production, will be considered as outlay cost. Now opportunity cost, what do we mean by opportunity cost? Opportunity cost is related to the cost of foregone opportunity. Now what do we mean by cost of foregone opportunity? Foregone opportunity means when you are given two alternatives, and out of these two alternatives you have to select one. When you select the one alternative, you are required to forego or sacrifice the another alternative. The another alternative that you sacrifice in order to select the best alternative, that sacrifice is known as opportunity cost. Let us take one example. Say for example, you are offered a job in company X, and company X is going to pay you the annual package of 15 lakh rupees. You have got another offer from company Y. Company Y is going to give you an annual salary package of 17 lakh rupees. Now you have two offers, offer from company X and offer from company Y. Which will you select? Definitely you will select the best one, that is offer from company Y. Company Y is going to offer you 17 lakh rupees. Now if you select the offer from company Y, it means that you are going to forego, you are going to sacrifice the offer from company X. Now this sacrifice is known as opportunity cost. So very much simple, opportunity cost means the cost of alternative that you have sacrificed. In order to select the best alternative, you have to sacrifice the next best, and that next best alternative which is sacrificed, which is considered as opportunity cost. So opportunity cost is nothing but the sacrifice for selecting the best alternative. Now outlay costs are recorded in the books of accounts. Outlay costs will be recorded in the books of accounts. It means explicit cost or accounting cost are recorded in the books of accounts, but opportunity cost is not recorded in the books of accounts. Opportunity cost is simply just for mentioning the alternatives, or it is useful for decision making. It is not recorded in the books of accounts. Now you cannot record in the books of account that in order to select the job of 17 lakh rupees you have sacrificed the job of 15 lakh rupees. This is not going to be recorded. So opportunity cost is useful for just decision making. It is not recorded in the books of accounts, but outlay costs are all recorded in the books of accounts. Another concept is a direct cost and indirect cost. Direct cost means what? Direct cost means the costs which are readily identifiable and traceable to a particular product. They are considered as direct cost. The costs that are readily identifiable and traceable to a product. It means that by seeing the product, you can identify that this particular cost must have been incurred. So that is considered as direct cost. Whereas indirect costs are neither readily identifiable nor traceable to a particular product. That is considered as indirect cost. It means that by seeing the product, you cannot identify that this cost must have been incurred in it. So that will be considered as an indirect cost. So for example, if you consider a product, for example, a bench. Now by seeing the bench, you can identify that the cost of wood and the cost of iron. Now cost of wood and cost of iron can be recognized, it can be understood, it can be identified that this amount of wood has been utilized or this amount of iron has been utilized in this manufacturing of the bench. So the cost of iron and the cost of wood will be considered as a direct cost. Whereas in that particular factory where bench is manufactured, electricity must have been used. Now you cannot identify that what amount of electricity has been utilized for manufacturing this particular bench. So the cost of electricity will not be considered as direct cost, it will be considered as indirect cost because the cost of electricity cannot be readily identified. Another example, the factory where benches are manufactured, telephone must have been used. Now by seeing the bench, you cannot identify that what amount of telephone bill has been incurred on this particular bench. So the telephone bill, it is neither readily identifiable, it cannot be recognized from seeing the product. That is why that is considered as an indirect cost. So the cost which can be identified and traced are considered as direct cost, but the cost which cannot be identified or traced are considered as indirect costs. Examples of direct cost: manufacturing cost are direct cost, and electricity cost is considered as an indirect cost. Next comes fixed cost and variable cost. Fixed cost, name itself suggests that it does not change with the changes in the output. That means whatever be the amount of output, the cost will remain same. If the production increases, the cost will not increase. If the production decreases, the cost will not decrease. If the production is zero, the cost will not change at all. So at all level of output, the cost remains the same. Say for example, the rent of factory building. For example, the owner needs to pay 25,000 per month as a rent. Now if within the month the producer or the owner of the business produces 500 units, what will be the amount of rent to be paid? 25,000. If the producer produces only 100 unit, the rent will remain 25,000. If the owner does not produce any unit, the production is zero, the rent must be 25,000. So at any level of output, whether the output increases or decreases or output is zero, the cost is not going to change. This cost will be considered as fixed cost. Variable cost. Now variable cost on the other hand means the cost which changes with the changes in the level of output. That means if production increases, the cost will increase. If the production decreases, the cost will decrease. And if the production is zero, the cost will be zero. For example, the amount of raw material, the cost of raw material. So for example, in order to manufacture 1 unit, you require raw material of 10 rupees. Now if you produce 5 units, the cost of raw material will be 50, because 5 quantity 10 units 10 rupees is the cost. 5 into 10, that is 50, that will be variable cost. Now if you manufacture 1000 units, 1000 into 10, again it will be 10,000. The cost has increased because the production has increased. If you manufacture 0 unit, at 0 unit of output, the cost will be 0 because no material will be required. So the cost increases when the production has increased, the cost decreases when the production has decreased, and the cost has become 0 when the production has become 0. This kind of amount, this kind of cost will be considered as variable cost. So fixed cost, which remains fixed at any level of output, whereas variable cost has positive relationship with the production. If production increases, cost will increase. Production decreases, cost will decrease. So that's all for